A tale of two markets. Why property selection matters now more than ever. Hey everyone, Aidan here with another iStrategic Weekly Insight for Friday the 26th of June. Happy end of financial year everyone. Not all markets move together. In fact, two properties purchased at the same time in the same country can produce dramatically different outcomes over a decade. One might deliver really strong capital growth, rising rents, improving cash flow. The other may leave investors wondering why their property has barely moved despite years of holding costs. This week, I want to highlight a real-world example of exactly that, because one of the biggest misconceptions in property investing is that buying property is enough. The reality is quite different, is that location, product type, supply levels, and local market fundamentals matter enormously. So for the first example, we're going to look at Melbourne CBD apartments. Over the years, I've heard plenty of stories from investors who purchased properties that simply didn't perform. In many cases, the common theme is not necessarily poor timing, although that matters, it's poor asset selection. Okay, a great example is Melbourne CBD apartments. While these properties may initially appear attractive due to affordability, convenience, and rental demand, many investors have experienced extended periods of limited growth or properties actually going backwards. One of the key reasons for that is supply. When large numbers of similar apartments are built in the same location, buyers and tenants have plenty of choice. That abundance of supply can place pressure on both downward pressure on capital growth and rental performance. This highlights an important lesson. Strong population growth alone is not enough. Investors also need to consider the important balance between supply and demand. Now, I'm going to show you some data from our friends at Hotspotting to illustrate exactly what I'm talking about. So here we have some data from Hotspotting about Melbourne CBD apartments. On the left, we can see inventory. That's how many properties are on the market at any one time. There's 5 months worth of inventory. That's too high. We generally want no more than 4 months, but preferably below 3 months. Median days on market is well above the national average. That sits around 30 to 33. This is 46. The key indicators, this is where the horror story really kind of shows up. Over the last 12 months, prices have gone backwards 8.5%. Over the 5-year average, they've gone back 3.14%. Over the last 3 months alone, backwards 3.64%. Now, vacancy rates are pretty good, 1.85%. And you can see on the right, the median price point is very low, 460,000. So the one good piece of information is that the median rental yields are quite high because the rent, when compared to the purchase price, is quite high. But here's the 5-year growth average. It's a pretty ugly picture. So it really peaked around 2013, 2014, and has gone steadily backwards since then, even well into the minuses. So we're talking a long time. Here's the rolling 12-month median price point. We can see it peaked around that same sort of time and has not recovered since that time. So what I'd like to do now is show you the second example, which is completely different. These are townhouses in one of Brisbane's high growth corridors, which is the corridor of Logan, the southern growth corridor. So this is a market we've transacted in. Many of my clients have purchased properties and done really well in this area. The region has benefited from several key drivers, being strong interstate migration, a lot of population growth, infrastructure investment, expanding employment and job opportunities, and ongoing housing demand because of all that. Importantly, many of the properties we've targeted have also been located in family-orientated communities where owner-occupier demand remains strong. So that combination of demographic growth and owner-occupier appeal can create a very different investment environment compared to high-density apartments markets. So while no market performs indefinitely, areas with multiple growth drivers tend to have a stronger foundation for both rental demand and long-term capital growth. Now I'm going to look at the data from our friends at Hotspotting again, this time for a suburb in that Logan corridor called Logan Home. We can see inventory is quite tight, 3.3 months. short days on market, 28 days, which is solid. And the growth metrics have been incredible, 20% in the last 12 months. The 5-year average has been 15.9%. The 3-month change, so really recent, has been 5.8%. The vacancy rates are very low, 1.12%. We can see on the right here that it's a much higher median price point now, about 910,000. Now, 5, 6, 10 years ago, that actually would have been a similar price point to what you would have paid for the same Melbourne CBD apartment. Now, here we see the median sale price over 12 months. It's grown steadily up and to the right, starting around 2019. And the 5-year rolling growth chart, same sort of thing, around 2020, 2019, 2020, started a very, very strong upward trajectory. So, look, that's just a few bits of data that we look at. I use those to illustrate the point, okay, that data should drive decisions. So one of the biggest mistakes investors make is purchasing based on marketing rather than market fundamentals. So a polished brochure, an attractive display suite, a slick salesperson, or a rental guarantee can often distract from the underlying numbers. What I do is I help investors focus on a different set of questions, one being, what does the data actually tell us? Some of the things that we look at iStrategic are population growth, employment trends, supply pipelines, vacancy rates, infrastructure spending, owner-occupier demand, as well as historical market performance. The point is, no single metric guarantees success, but when several positive indicators align, the probability of achieving a stronger outcome improves significantly, and that's what we're going for. There are no guarantees, but we're trying to increase our probability of success and outperforming the market averages. The takeaway isn't that one city is good and another city is bad. The takeaway is that market selection matters, product selection matters, research matters, and timing matters. In my view, investors should spend less time focusing on headlines and more time understanding the specific drivers of the market they're entering. Because the difference between an average investment and an exceptional one comes down to decisions made before the purchase occurs, as we've just seen in those two very different examples and the different outcomes that have happened over 10 years plus. Now, every market carries risk. Okay, growth corridors can slow, population trends can change, infrastructure projects can be delayed or canned altogether. Likewise, markets that have underperformed for a period can eventually find a bottom and recover. This is why investors should avoid making decisions based solely on recent performance. Instead, the focus should remain on understanding the underlying fundamentals and whether those drivers are likely to remain in place over the long term. Finally, this week's comparison serves as an important reminder that property investing isn't simply about buying real estate, it's about buying the right asset in the right market for the right reasons. The gap between strong performing and underperforming investments can be substantial, as we've just seen. That's why due diligence matters and data matters. That's why understanding the market before you buy can make all the difference to the outcome. If you'd like to better understand how we assess markets at iStrategic, how we identify growth drivers and evaluate investment opportunities, feel free to reach out. We're always happy to share the research and insights behind the decisions that we make. Thanks very much for listening. That's it from me. Have a great week.